All right, here's another adjusting entry for because of deferred expenses. What that means again is that when you purchase supplies, you record them as assets, not as an expense, because you still have the supplies. You don't expense them until you actually use them. And when you use those expenses, they help you to generate revenue. So let's look at an example here where on May 1, we'll say Know It All had $900 of supplies on hand. So we'll say their beginning balance was 900. That's what they had left over as of the end of April. Now what happens in May is they buy $200 more of supplies. So what they're getting is what you'll debit. You're going to get supplies. You debit the supplies account. And what we credit is either cash, and since it didn't say on account, it would be a credit to cash. If it had said it bought $200 of supplies on account, then you would credit a payable, a liability. All right, now what we're getting at here is the end of the accounting period. And what's happening here is on May 31, it has only $400 of supplies left. Well, if you look at the account right now, it's saying you have $1,100. So if you were to do your balance sheet at that point, you'd be misstating your situation, and you'd also be showing you've used no supplies during the period, which again is not true. So we have to make an adjusting entry so our income statement and our balance sheet will be properly stated. So how do we do it? Well, what this is saying is that at the end we need to have an ending balance of 400. How are we going to get to an ending balance of 400? Well, you basically have a formula. You take 900 plus 200, which is 1100, and you're going to subtract x to get to 400. When you make that calculation, you find that you have used 700 of your supplies. So let's go ahead and debit supplies expense for 700, and what you'll credit is supplies by 700. So when we post that, you're going to debit again supplies expense, and we're going to credit supplies. By doing that, our ending balance will be the 400 that we're supposed to end up with. So the way again you calculate it is you take your debits, subtract x, and have it set equal to 400. Then you solve for your unknown and you will get 700. As far as the financial statements go, your income statement will show that you used $700. It's not going to show how much you paid though. That's what the cash flows will show, and that will show the amount paid for supplies, and that will be 200 on your statement of cash flows. And actually, it's a negative 200 because it's cash going out. So those aren't the same, and the reason being is you still have supplies on your balance sheet. That supplies of 400 on your balance sheet shows how much you have yet to consume that you've already purchased. So income statement tells you what you used. Cash flows tells you what you paid. They won't be the same. The balance sheet will help to explain some of that difference, and it's saying here that, well, we have 400 that we have not yet used. So this is again the expense recognition principle. Record the expense not in the period paid, but in the period that you've used or gotten the service.